Hello, Stephen Cruz here with mymortgagebroker.com, and I just wanted to talk a little bit today about reverse mortgages. But before I do, make sure you click on the subscribe button below and like this video, and then you'll get more of our videos as we create them. So let me just share my screen here, and then we can talk a little bit about reverse mortgages. So I do get quite a few questions these days from clients about reverse mortgages. Sometimes it's clients who, it's normally clients who have parents who are getting elderly and who are thinking about it. And my clients will call me and ask, well, how does it work? Is it a good idea? Should we do it? What do you think? And so I've written a number of articles on my website that talk a little bit about reverse mortgages, and I'll put those links in the description below. And one of the articles I wrote is how does a reverse mortgage work, and it just goes through who qualifies, and there's a bunch of details and questions and a couple of case studies on situations with clients who've taken them. I go into a bit more detail on another website or another page that talks about who qualifies for a reverse mortgage, and again, I review different options and just different situations. And then I did a third article called what are the pros and cons of a reverse mortgage. So this goes into lots of detail, and please feel free to read through those. I do try to provide as much detail as I can in those articles when I talk about reverse mortgages. So before I start, the reverse mortgage is good for clients in certain situations. If you're looking for financing and to get access to equity in your house, and many seniors nowadays, have built up a bit of savings, but a lot of their net worth and a lot of their assets are tied up. The equity is tied up in their home. And so they've worked all this time to build up this large nest egg that's stuck in their house, and there isn't a lot of ways to get access to it. Many seniors don't want to move from their house. They like their home, they're comfortable there. They've got memories there, they want to stay. And so moving out, selling isn't an option. For others, moving is an option and selling is an option, and maybe that's a better option than taking out a reverse mortgage. But that all of this equity creates this need to draw some money out. And so if I were advising you early when you're just getting ready to retire, or if you've got your mortgage paid off and you're close to having your mortgage paid off and you're going to retire in the next year or two, or if you've just retired, then what I would recommend you do is set up a line of credit first. So rather than choosing a reverse mortgage right up front, I would set up maybe a home equity line of credit. There's lots of lenders that we have access to that will often reduce or cover the cost of the legal fees and the appraisal fees just to set up that line of credit for you, because they know you're going to draw on it in the future, and so they're willing to cover that cost up front. And so then you have access to the money, but you don't necessarily need to use the money right away. And you can use it more strategically. If you use a line of credit, you can draw it in and out, etc. As you see fit. You can use it for tax planning. If you have an accountant or an investment advisor, you can use it to help some of your tax planning. And there's all sorts of strategies that people use a home equity line of credit for. If you have a mortgage when you retire and you're really trying to pay it off fast, then you want to be careful with your cash flow. And I've seen some clients who dramatically increase their payments because they really have this goal to pay off their mortgage close to or when they retire, but then the other things start balancing, other balances go up, like credit card balances and loan balances start going up, and so now they've paid off their house, but they've got all this other debt, and your house typically has the best interest rate. And so if you're going to try and utilize your home to the best advantage, it might actually be better if you just refinance that mortgage, amortize that payment over the longest period of time, because the banks won't say, well, you're 65, you can only amortize for 20 years. That's not the case. You can amortize up to 30 years potentially, or if you set up a line of credit, you can have interest-only payments, which means your mortgage never gets paid off if you make the minimum payments. but you could reset the debt that you owe and just make it a line of credit or a mortgage over a longer amortization. So it keeps your payments low and it helps you with your cash flow. If that's the case, and if you got a small mortgage, then I would, if I were in that position, I would typically set up a combination of mortgage and line of credit so that you have a fixed interest rate and payment for debt that's already there, and then have a line of credit available for whatever extra room you can that you can use and dip into as you need it and if you need it. Some clients, when I meet with them, and they're asking about their parents or whatever, and their parents are looking because they have some cash flow issues or whatever. A lot of times their kids who are probably in their 50s will want to help them. And so instead of setting up a reverse mortgage, what I have done with some clients is the parents will set up a line of credit on their house. They'll draw some money out of it, like income, and then their kids will make the interest payments on it. Interest rate for a line of credit is probably a percent or two below interest rate available on a reverse mortgage. And so if the kids are paying the interest payments, which on a couple $1,000s isn't going to be much, once it gets over 100,000 or whatever, it's going to be more. But if there's multiple kids, they can spread out that cost, and then they're not eating away at the equity of the house if that's important to them. Some kids say, you know what, this is your house. We don't need any inheritance money. We don't want you to be giving us any money. We want you to spend everything. You enjoy the money you worked hard to make. And sometimes that's the case. And so you can either set up a reverse mortgage, or you can set up a line of credit and just let that interest accrue. And then when you're ready, you can sell your home and get access to the rest. The difference between a line of credit and a mortgage, the line of credit is set up with a limit. So is the reverse mortgage. The line of credit is set up with a limit. So is the reverse mortgage. The line of credit, the interest is due on a monthly basis, whereas with a reverse mortgage, the interest is just added on top, just tacked on top. With a line of credit, you can draw out, say, $1,000 a month or $2,000 a month as you need it to help supplement your income. With a reverse mortgage, you can do the same. Most reverse mortgages, there's two in Canada, but they have a minimum requirement that you take out, $15,000 or $20,000 per year. Each one's different. So let's say it's $20,000 a year. So that means you have to take out about $1,600, $1,700 a month to cover that. Is that right? $1,800 a month to make up to the $20,000 a year. But as you draw the income, the money out, the interest on that money is accrued on top. For the home equity line of credit, you can draw the income out, then you can draw an interest payment out as well that covers the cost. So you can effectively cover the interest cost within the line of credit, but now it's compounding within the limit. So your limit gets used up faster, because if you draw out the $1,800 a month and you draw out enough to pay the interest on that, so let's say you have to draw out $1,900 a month to cover that interest, and it's going to go up every month, because as you draw more and more and more, you're going to have to pay more and more interest. But you can draw that extra out, and then the interest is paid, and then it accrues on top. So the limit the amount you owe will quickly reach the limit, but it's at a lower interest rate. On the reverse mortgage side, you draw the funds out and the interest is accrued on top of the limit. So you're allowed to draw out all of this, the total limit that you have over time, with interest accruing on top. So there's an advantage there that you don't really have to worry about playing around like you do with the home equity line of credit. Both can be utilized similarly. The interest rates are slightly different. The line of credit has lower interest rates. The reverse mortgage has a higher interest rate. It's more cost to set it up, and I've never seen the lenders offer free appraisal or free legals. Whereas with a home equity line of credit, I have a few lenders throughout the year that offer promos where they'll cover the cost here and there, and so it won't cost you as much. So there is a cost between the two. But in some situations, the reverse mortgage is the easy way to go. Well, I've noticed in seniors, they want to make it simple. They want simplicity, and having a complicated mortgage and having to make the payments all the time and tracking all that stuff gets to be too complicated. And it's just easier not to have to think about that. So in that case, a reverse mortgage may be the answer. So what I've done, and I'm on this page right here on my website, there is a there are some pros and cons that I did review related to the mortgage. So you can go on my website, mymortgagebroker.com. What are the pros and cons of a reverse mortgage? And then you can just read through all of them. And there are a lot of advantages. There's 11 advantages to the line of credit. They are specific, and there are advantages for certain kinds of clients. Not every client should take a reverse mortgage, and I would encourage you to look at all your options and decide before you jump in just to a reverse mortgage. And that's why I often recommend to my clients, chat with a mortgage broker, either chat with me or chat with another mortgage broker who is familiar with reverse mortgages. Because if you just chat with the companies that offer reverse mortgages, they're going to give you their own perspective, their own opinion. They may not give you an expanded opinion about other products that are available. So there are some decent advantages, and staying in your home is one of the biggest advantages that seniors have with the reverse mortgage. The disadvantages, and I have those red at the bottom, but there are some disadvantages. I can't think of as many, but and I've spelled that wrong. But potentially lost equity. So because the interest accrues, the longer you stay in the home, the more interest will accrue, and it will eat away the equity. In Canada, you're guaranteed never to outlive your mortgage. So as long as you live in your home, as long as you have a reverse mortgage on your title, they will never kick you out. They want you to maintain the property in good repair, but basically they will allow you to stay there. They will never have the equity grow beyond the value, and if it does, you won't lose your house. The setup costs of reverse mortgages are a little higher than lines of credit or mortgages, and you may not get as much money as you need. So depending on your age, the real factor in qualifying for a reverse mortgage is your age. If you're 55 years old is the earliest you can apply for a reverse mortgage, and you're not going to qualify for as large a percentage of your home as if you are 85. The maximum lenders will allow is 55% of the value. So a reverse mortgage can't exceed 50% to 55% of the value of your home, but you're not going to get that when you're 55. It's going to be closer to 25% of the value of your home. And then if the reverse mortgage is not for a short-term solution, you don't want to use this if you're planning on selling within a couple of years to move to something else. The penalties are much larger in a reverse mortgage at the beginning of the term. Over time, then they reduce to typical payout penalties that most traditional mortgages have. But initially, for the first few years, those penalties are quite large. And so you don't want to do this as a short-term solution. The best option for a shorter-term solution would be a home equity line of credit. So if you're selling your existing home and buying another home, and I've had some clients do this, they asked for a reverse mortgage, they didn't make a lot of income, they owned a house worth over $1 million, and they were moving into a condo, it was more in the $400,000 to $500,000 range, and they were thinking they could get a reverse mortgage, and that's what they asked me for, was a reverse mortgage. But when I explained the penalties, we looked at the options, we looked at what they did and didn't qualify for, really the line of credit was the way to go. And that's what we did. We set up a small line of credit on both properties. And then when this one was sold, it was paid off, and they had this line of credit on the new one that they could draw on if they needed to in the future. So it set them up for the future and gave them an ability to manage their cash flow and their income taxes and all that sort of thing. So hopefully that helped and that answered your questions. Please visit my website and read those articles if you have questions. They answer a lot of different questions about reverse mortgages. And if you have questions for me or wanted to know a little bit more, then please connect with us. My phone number is in the top of this this page right here, and you can phone or email me. You can apply, you can click on apply now and just connect with me. You don't have to fill in the application. But again, don't forget to subscribe to the video, press like, and you have a fantastic day. Thank you.